than the actual PowerPoints do. And if not, hopefully you have that reference. How many of you have a hardback book? Does anyone have, well, you wouldn't have the hardback. Does anybody have the low print version of the book, or are you all using ebooks? Okay, Rebecca bought the low print. Chad uses the ebook. Okay. And some people may not even realize there's a low print version available, but there is a low cost print version, which is basically, I believe, I haven't seen one, but Rebecca, I understand that it is just printed on white paper. Is that true? Just like printed out like a PDF, like kinda? Is glossy white? Well, that's not so bad then. Okay, and you put it in a binder, I assume. Yes. Okay, so that's something for those of you who like to have a book, a physical book, to remember in the future. The publishers are providing low-cost print versions. They're not all pretty and colored and everything, but if you like to read or have a book to reference, they work just as well. Now, if I can just remember to turn my pages on the screen, I'll be good. So anytime that we are using functions such as future value or present value, or if we're computing interest, those type things, Excel is our best friend if we can learn to use it, because it can do so many of the computations for us and help us to properly or get the proper amounts. Excel is more accurate than if we're using tables to compute interest, so that's something else that we need to look at. I don't know how many of you ever take the time to do things like log into the internet to learn about the current stock price and trading value of companies. It's kind of interesting to watch, and I lots of times in my face-to-face classes I will have a student price stock early in the semester and then watch it and track it during the semester. Usually there's not too much change during the semester, but it still gives the student an idea of how many ups and downs there are, and if you could buy and sell stock at the right time, how much money there is to be made or lost, of course, in the stock market. Okay. So we want to really think about how we're going to invest when we get ready to invest in stock. You know, how are we going to determine what it's worth and how we would record it. There's a question on your final, I believe it's still there, that asks about this stock information. It asks you, it'll say, talk about a newspaper clipping, or out of the newspaper, how would you know what the selling price was on your stock? And so lots of times students say, well, the book didn't even talk about that, but here it is, sure enough, right here on our Exhibit 8.1, it shows how stock information is reported. And so we would know what our high was for the day, our low for the day, which stock it was, how much dividends it's paying, its closing price. So its closing price, if I asked what the stock was selling for today, it would have been $21.26 at the end of the day. And that's what I would have recorded it at had I purchased it at the end of the day today. So the question asks you things like that, and you answer from it. But there it is in the book. It's this little blurb. We don't really talk about it very often. I often skip over entirely when it's just not something that seems important, and then a final exam question pops up on it for you. So we want to know that investments that can be converted quickly to cash, and the investor must intend either to convert the investment to cash with 1 year or use to pay a current liability. That would be a short-term investment. Okay, and with a short-term investment, that's going to be a marketable security. It's going to turn into cash really quickly, or we can turn it into cash. If it's longer term than that, we're not intending to turn it in or to cash it in for more than a year, then that is going to be a long-term investment, and that determines that it belongs in the long-term investment section on assets section on the balance sheet rather than short-term. We have to classify as long or short. You have some examples in the book. I'm not going to read the book to you. That's not my goal. I just want to pick out the important things, only not doing it with the actual slides. If we look at the item here at the top of page, can't keep up with my pages. Guess it's not really at the top of the page. It's on page 431 where we look at where it's telling us how Chapter 8 is talking about how the investor or the bondholder versus Chapter 9, which is going to talk about the issuing corporations. Lots of the things that we learn in Chapter 8, such as how to compute the issuing price of a bond, carries over to Chapter 9. It doesn't matter if we are the investor or the investee in this case. The computation of the selling price or the issue price of that bond is exactly the same, which is the amount of cash that would either be going out or coming in, depending on if we're the investor or the company issuing these bonds. Do you know what the difference in a bond is versus a note? Scramble. Maybe time. It could be, I mean, we typically think of bonds as perhaps being longer term than perhaps a note. It's more the makeup of how these bonds are issued versus a note. Okay, so bonds are really, it's a big, the company's going to need to raise a large amount of money for some usually specific purpose. They're not going to just run to the bank and borrow the money. Usually if you go to the bank and sign a note, or you might have your customers sign a note with you, that's a note. It's a written promise to pay. You know, it's paid to one person and collects interest. And a note can be long-term. I mean, you could have a note for 20 years if you wanted to. But typically, they wouldn't be for as much. If I needed to raise $1 billion, then I'm going to go through this whole legal process and come up with a bond indenture, a whole contract of where I'm going to issue these series of bonds. And it's not all to one person. Many, many, many people will buy into this one bond. Some might, maybe $10,000 worth, and up to $1 billion, up to $1 billion. And then there's several people earning interest off of these bonds instead of just one. If you have a retirement fund, if any of you have a retirement fund, lots of you may have invested in some bonds or mutual funds within that, and that's often thought of as bonds. There's lots of bonds in mutual funds. So anyway, they're just a longer term, it's a contractual process to get this bond indenture in place, ready to issue the bonds. Okay, some more terminology. Let's go back and think about our held to maturity investments. That's a classification of investments. We plan to buy those investments and keep them until they are mature. That maturity could be a short-term maturity, like they might mature in 90 days, or they might mature in 5 years. But whatever the held to maturity is, that is our intention. It doesn't mean we can't change our mind and sell them before we thought we were going to. We need to have them classified on our balance sheet, any of our investments classified as what our intent is. So if we have classified something as long-term and then we decide, nope, I'm going to sell that investment, I'm going to cash that investment in by the end of the year, then I need to move it on my balance sheet to my current assets out of my long-term. If we have held-to-maturity investments, they are reported at the amortized cost method, which means we determine the carrying value. Bond investments are initially recorded at the market price of interest times the par value of the bonds, and we'll look at some of those examples. That's what one person had asked me questions about. They had been trying to compute the issue price and not getting the issue price. Not sure why, but we'll look at that. It's easy to put in a period decimal wrong and miss something, or forget to divide by the number of periods, or multiply, and whichever you need to do, whether it's interest or periods, and get the correct answer. And I know this probably all just sounds like gobbledygook right now, but as we get looking at examples, that should help. So if I am issuing bonds here, as we're talking a little bit about bonds early in the chapter, if I issued bonds that are selling below face value, the interest rate is below market value, it would be why that would be issuing that bond at a discount, and we have to work to amortize that discount amount to bring the bond back up to face value. If I sell it above what its face value, which I would do if the market rate is higher, then I have to amortize that premium back down over time. We really don't work much with the amortization in this chapter. We work more with amortization in Chapter 9, so you have something really fun to look forward to. I was teaching that this week to my IUE students, so if you wanted to talk to them, they would tell you that it wasn't very much fun at all, but it'll be fun for you guys. Okay. So the book goes basically through the basic examples of recording these different investment types. I want to actually spend a little more time on the bonds when we get there, but it's just pretty basic. If we have held-to-maturity investments, then we are going to record those at whatever our purchase price was. We will receive interest at the base value of interest. This is the actual cash interest we would receive, and then we need to do the interest revenue is going to increase actually our investment in that bond each time we receive the revenue. Looking at page 433, if you can get to 433, are these pages showing up better than the PowerPoints, or is it about the same time processing on your screens? They show up better? Okay, they seem to. Okay, good. Well, I will work toward doing this. I decided I would do this. I got home late tonight, and I really didn't have time, but if I would have the time to go through and pick out specific pages, that's probably going to be much better for us over time. Live and learn. Anyway, on page 433, there's an example of Intel's balance sheet again, and it is showing how we have current assets, and in those current assets we have interest receivable, held-to-maturity investments. We have our property, plant, and equipment, which we covered in Chapter 7, and then on the income statement, they wanted to show that the interest revenue would be related to these investments. If I have available for sale securities, then cost is only used as the initial amount for recording the purchase, and at the end of each recording period, we have to adjust these to their fair values. if you're going to be doing problems in your homework, and you do have at least one problem in your homework of where you have to compute to fair value or do the adjustment for fair value, it gives you that fair value up in the instructions. And I know that's something that a few students were struggling with, is not understanding how they could come up with the fair value. And it's your recorded cost in the beginning less what it tells you your fair value is at the end of the year. And it's just information that's given, just not given real, so it jumps off the page at you, I guess. So I continue to go back to, you have to read. Oh, so Blue, you don't have any trouble. You must have a really fast internet if you don't have any trouble with the PowerPoints lagging on you. Because I know it can be really bad, and even when I go to play back the video, it can be really, really slow sometimes. But that's good. Again, available for sale, you have to adjust for the fair market value at the end. If I'm looking at accounting methods for long-term stock investments, then the rules are in equity securities such as stock. It depends on the percentage of ownership by the investor. If it is less than 20%, it is available for sale security, and we use fair values. If it's 20 to 50%, we record that as the equity method, which means we actually record to the investment. And if it's more than 50%, then we use the consolidation method, which is what I pointed out at the beginning about Intel using a consolidated financial statement that we were looking at. I know that one of the homework problems is very similar to the, it's very similar to the exercises here as shown in the book, the examples here on page 434, where we are actually investing in some available for sale stock. That's what AFSS stands for, the available for sale stock. And then we are assuming that they receive a dividend, and how we record that dividend. Just this is an example of walking right through one of the homework problems. And then when we get down to the fair market adjustment, it's again, according to GAAP, we have to recognize that there are three different approaches. We have the quoted price in active markets. We have estimated based on other observable inputs, and we can estimates based on unobservable, such as the company's own estimates based on certain assumptions. And we have to use fair value, right, as I said. And you can do any of these three methods to determine what your fair value is. And then here is an example of recording the journal entry that it would take to record the difference. And as I said, this is one of your homework problems, or a problem like this. So you'll want to know that you can go back and reference pages 434 through 435 to get through one of the homework problems. We're not going to do a lot of talking about comprehensive income. At this point, it's really a more advanced topic, so hopefully you don't get caught up in a test question with that. But on page 436, they show you how you actually would record your consolidated income in the statement here. If we had unrealized gains on our sales, it goes under other comprehensive income on our financial statements. If I sell an available for sale security, then I need to actually, I'm trying to figure out these pages. Oh, I see. It says 436, 437. They don't exactly correlate with my book, which is a little odd. But once I sell, then I need to just like any other asset that has the asset and the related account, such as when we had a piece of equipment that we sold, we had to get the piece of equipment itself off the books and its related accumulated depreciation account. We always have to make sure that we get all of those accounts removed when we are selling something. So in the case of an investment that we have available for sale, if we have an unrealized gain on the books, we've got to get that off. If we have an unrealized loss on the books, we have to get that off. Same difference. We have to eliminate that gain or loss that is related to that specific investment that we're selling. And we don't talk a lot about subsidiary ledgers. We've talked maybe a little about them, but how you would have to have subsidiary ledgers for your accounts receivable folks, your customers. You'd want to know how much each customer owed you. And accounts payable, you need to keep a record of all of your vendors and how much you owe each vendor. Those would be thought of as common subsidiary ledgers, but we are also going to keep subsidiary ledgers to keep track of all of our different investments. We need to know what day we buy them, what day we, what we paid for them, what their interest rates are, their terms, so that we know when to be coming up ready to sell them if they are maturing, and then maybe you're going to quit earning interest when they reach maturity, so you don't want to let something sit around that you're not earning interest on. And so with that, we've got to keep track of all of these individuals so that we know if we have 5 different investments and we have a gain, one gain account, we've got to know what gains are attributed to which investments. Okay, and then you're going to have a realized gain or loss once you actually make the sale. The unrealized is gone. Okay. Has anybody ever worked with any type of investments in your jobs anywhere? Nope. No. I worked in the for-profit company I worked for. We had some investments that we had to account for, but I just, I think about it and I just don't really recall doing a whole lot with those investments. I mean, we would record them and record the interest. Yeah, kind of a little. And it's funny, this is one of the things that I struggle with applying to real world, because I just never really, or having great examples of how I would apply to real world, because I've just never really done much of this in the real world. I guess the companies I work for just were putting their money back to work within the companies instead of investing in other companies. So if I buy a large stake in another company, such as 20 to 50% of their voting stock or ownership, I have enough that I may significantly influence the business activities. I probably can affect dividend policies and product lines and other important matters if I actually vote. And in that case, I would want to use the equity method to account for the types. Equity method, I would actually look at, make my screens go crazy here. I would look at actually having, I would record it as an equity method investment when I bought it, and as I get investment revenue, that is going to increase that equity investment as I go. So my investment is going to continue, my actual asset investment account continues to increase as I get in revenue for that company. And again, the entries are right here in the book, but if I receive dividends, that's still going to be, I'm actually going to get my cash, and then my equity method investment would go down because it's my investment and I'm paying dividends out of it. And again, you see some of this in your homework too. If I have a controlling interest in another company, then I'm actually going to have ownership of more than 15% of that company. Then I will be recording this as a consolidated company. So all we do is we combine all the financial statements from all the different companies that are controlled by the same stockholder. It provides a single set of financial statements for the consolidated entity, which carries the name of the parent company. I can't remember how many companies Hathaway Berkshire has, but they report all of those companies together under Hathaway Berkshire, and they actually then each company is going to have their own separate financial statements, and then they're all reported as one consolidated. So we have here a consolidated worksheet of how we are figuring out how much each company has and how we are going to eliminate amounts that need to not be on the parent or subsidiary. For example, if the parent company had a note receivable from the subsidiary, then those are going to net out to zero, is what this is showing you here. If we had an investment in a subsidiary, it's going to be a debit on one company's and a credit on another's, which makes the balance zero. The income of this consolidated entity would be reported. It's showing here as 100%. The parent ownership of each company is 100%. Then it would report 100% of the parent companies. If it owned 100% of a subsidiary, then it's going to report that whole amount. If they owned only 60% of a company that had a $100,000 loss, they're only going to report 60% of that, or $60,000. That's what they're showing in this, just to get the idea of how this works. Enron is interesting, so maybe you should take the time to read through this little Enron Cooking the Book section. And I always recommend, if you've never seen The Smartest Man in the Room by Enron, well, it's not by Enron, but the story of Enron, called The Smartest Man in the Room. It's a really good video to watch because it's just appalling at what these folks were doing. If we're going to account for these long-term investments, we need to think about who owns these bonds, and then we will amortize the cost. If they own a portfolio of bond and other debt securities that they have less than 20% ownership in, they will record those at fair market value and hold them to long term. And if they own 20 to 50, it would be equity, and if it's 50% or more, it would be consolidation. Just the different terminologies for the percentage of ownership. And these mid-chapter summary problems are always really good for you to work through. I don't know if you have in the end of chapter summary problems. They're just really, really good, and they provide the answers at the end, and great examples that show the whole process better than some of the My Accounting Lab tests or questions do. This chapter also talks briefly about exchange rates. We will, I say there may be a problem that talks about exchange rates. I can't remember for sure, but but at how you would convert to the U.S. dollar. So, you know, a pound is $1.52. A yen is 0.007. Peso 0.081. So for every dollar, that's how much you would get. 50 cents for every dollar. The Canadian dollar was 98 cents at the time they printed this book. Well, the U.S. dollar is 98 cents to the Canadian dollar, I guess. So a pound is $1.52, yeah. All right, so if you need to do a conversion, you would just pull up the conversion chart and you do that. So if I have 10 pounds, then it's going to be 10 times $1.52, for example. Part of this conversion of money is what goes into effect when we look at IFRS, or the International Financial Standards Reporting Board. We have to consider changing what the value is based on the market. And just some reading on that. Is anybody extremely interested in foreign currency exchange? I always like to go through and read it. It seems like, yeah, no, not extremely interested, but it's something that's nice to be aware that it's out there, so, and that it can change your financials if you're working with a international company, or it may potentially in the future. Right now we still report everything at dollars, and we don't fluctuate based on the market rate. But with, like I said, with IFRS coming down the road, that's probably going to change. So if we're going into the accounting field, then yeah, Kenyana is interested in it, but not very knowledgeable. I'm not very knowledgeable either. If I haven't traveled overseas for, oh my gosh, 40 years, I guess. It's been a long time. I went when I was a kid, basically. And so it's, if you're not using it, if it's not affecting your life, sometimes it's just really hard to make yourself stay on top of things. And yeah, it's intriguing. I agree, Blue. It is very intriguing. Kenyana, have you made money? Kenyana says one can make money exchanging currency in the markets, and I'm sure you can. Have you tried that yourself? It would just be really no different than playing the stock market. No, you stick to stocks. Okay, so you do play with stocks, huh? I've never done any fast trading of stocks, but I know there's money to be made doing that too. I have some stock, but I've never really watched the stock market and played the stock market, or what I would consider play the stock market. I've often wondered about treasury bills. Has anyone ever invested in short-term treasury bills and tried to make money that way? Nope. I think you would just have to have a lot of time and be able to sit right in front of the computer and watch the markets to make that play out. It's something I wonder if I could make money doing if I had the time. Okay, and I said we would talk about cash flow. Now, time value money. I want to spend more time on the time value of money. Has anyone ever really worked with the time value of money? Do you understand what time value of money is? Or the power, no, or the power, if I say the power of compounding interest, do you know what that means? Compounding interest. Okay. when we're looking at future values or the time value of money, we're not really looking at future value as much in this chapter. Yeah, we're not going to look as much at future values as we are at present values in this table or in this chapter, but what's important to think about here is that you need to understand that $1 in hand today is worth more than $1 in hand a year from now. I mean, if I'm going to give you $1 for you to spend, it's better for you to have it today than for me to say, oh, I'll give you, I'll give you $1 today, I'll give you $1 a year from today. Then you're better off to take that $1 today, because that $1 today can be put to work for you earning interest, compounding, and then the interest earning interest, which is what compounds mean. If I had $100 earning 10% interest a year, that would just be $10 a year, but then the second year I'd have $110 earning 10% interest, and so the interest earns interest, and that's what compounding is. And for several years you would always say that your money, it was just the rule of 7. Your money would double every 7 years. Well, with the economy the way it's been, our money hasn't been doubling every 7 years, but what that means would be if I invested $10,000 when it doubled every 7 years, I could invest $10,000 today, and in 7 years from today it would be worth $20,000. Well, then in another 7 years or 14 years, that would be worth $40,000. And so money used to grow pretty quickly. And it just does. I think it's supposed to take something like 21 years now for money to double right now in today's economy. And so it takes longer for wealth to accumulate, or to accumulate, not even just wealth, but for money to accumulate when it's taken 21 years for money to double. Still worth investing because your interest is earning your interest. And by the way, you only pay taxes on the interest income. You don't pay taxes on the money in your savings account like some people think that they do. But it's on the interest income off of the money that you pay taxes on. So why would we want to think about this in the terms that we do, or why is it important? I firmly believe that although this is a complex subject and difficult for lots of students to comprehend, this is truly a personal life skill. If you can begin to understand the power of compounding of interest, and if you can understand future value and present value, you can begin to see ways that you can use this. I like to share that you can make decisions, smart decisions, based on what would the net present value of this investment choice be, or this payment choice. Have any of you ever bought a new car or a new vehicle, brand new, of where you had a choice between 0% interest or a cashback rebate? Yeah. Well, with used, you don't usually get the offer of the 0% or the rebate, right? But if you were, you're all in school now, you're all going to get degrees, and you're all going to be making more money, right? I mean, somewhere down the road, we're going to someday be hopefully making money, and not necessarily, I'm not advocating that buying a new car is smart. I'm not going there, but if I'm going to go buy a new car, then lots of times the dealership will be running. They'll say you can have 0% interest for so many years, or we would give you a rebate of $3,000 or maybe $4,000, depending on the price of the vehicle. You might get a cash rebate. Well, lots of people really think, and then you don't get the 0% interest. Lots of times people just think, oh man, that 0% interest is such a good deal, I'm going to take the 0% interest. Well, with using present value calculations, we can determine if the 0% interest is a better deal than taking the cash rebate and paying whatever percent. You're right, Rebecca, you could earn interest on the cash. That's right. But if I'm earning interest on the cash, if I get a $4,000 cash rebate and I am using interest, earning interest on that cash, I'm probably not able to earn the amount of interest that I'm paying on the loan. I mean, rarely can you collect the amount of interest that you're paying. If you get a really, really, really low rate, but what I'm saying is you can just do that calculation. You can determine, am I better to take the 0% interest, or am I better to take the cash? And it's not always, I mean, there's never that it's one way or the other. I mean, I can't say it's always better to take the 0%, and I can't say it's always better not to take the 0% and take the cash. It depends on the interest rate that you would be paying on the loan that you had to borrow for the money. So it depends. It's a calculation, and so that's a useful method. Another thing is if I decided that I wanted to buy a home in 5 years, maybe I say, I'm going to buy a home in 5 years from today, and I know to buy that home I need $5,000 as a down payment. If I can get $5,000 as a down payment, I can buy a home. So then I can decide, well, how much do I have to save each year in order, or each month, or each quarter, whatever, to come up with that $5,000 at the end of the time. So I can determine what amount do I have to invest today. If I want to do a lump sum, it could be today. Maybe I want to say, I'm going to put back my tax refund, enough out of my tax refund that in 5 years it'll grow to $5,000. I can determine exactly how much that needs to be by using these calculations. And to me, that's power, and it's something that we can use in our personal life and to help us make smart decisions when we are making personal purchase decisions. So when we talk about future value, it's how much will something grow to in the future. So if I have $100 today, then it will be worth more somewhere at some point in the future if I'm earning interest on it, right? So if my interest rate, we have this little example that we're looking at here. Well, I had one. There we go. If I have $4,545 and my interest rate is 10%, then in 1 year that will be $5,000. It will have grown by $55 in 1 year. So, you know, I always say, well, that's starting at $4,000. If we were at $45,000, then we would start adding zeros. So if we had $450,000 to invest, you know, pretty soon you are up to making, you know, $10,000, $15,000, $20,000 a year in interest, and that's how things grow when we do that. Of course, we can't really find, if anybody knows of any 10% interest opportunities right now, I'd be happy to hear about it. It'd be wonderful to know of some place that I could get some interest. I don't think it exists, but if somebody knows of some secretive little place, I'd be happy to know about it. So page 450, maybe. Yeah, 450 shows how this value the future value would grow up over 5 years. So how we had started with $4,545 and earning 10% per year, how we could be up to $7,371 at the end of 5 years. That's pretty good. Have you done present value calculations in your math classes? Has anybody had 118 or 125 or 123, I think it's called now? Nope. Usually you will do some type of calculations with in math about present values and future values, but you you would just have a formula to follow. But we can do this using tables or Excel, either one. So here's, on the next page, it's showing all of these scary looking formulas. Okay. Or we can use the tables. So let's spend a minute here. Let's spend just a minute here and look at this. This is a present value of $1 table. We will be looking at present value of, I say often, a lump sum, but that's your present value of $1. And we'll be looking at the present value of an annuity. An annuity would be something that involves payments. So your house payment is an annuity. If you get some kind of a retirement fund and the payments start coming back out to you, that's an annuity. If you won the lottery and instead of taking a lump sum one-time payment, you decided to take it as an annuity or an annual payment back to yourself, then that would be an annuity. So that's the difference in the two tables. When we're talking about things such as bonds and investments, then we have to look at both the interest payment that would be earned and the lump sum of that to come up with our present value. So let's practice here just a minute if we can. I need to look real quick. I thought someone was coming that's not here. Let me check my... Yeah, real quick. Sorry, I just thought I don't think I left my mail open and I need to make sure. She says she hasn't received the link. Yes. Okay. You guys all got emails about this, right? No? Then how did you get in? Oh, you used last week's. See, something's not working right still. Well, that's not good. something's still not working right because, you know, I'm getting, I'm getting emails saying that emails have been sent. So I'll need to follow up with the state on that. So sorry about that because I just left a student hanging out there, it looks like, who thought she was going to be here. So I just sent her the link. We'll see if she can get in. Anyway, the present value table, the way this works is if I had $1,000, my Excel's gone. Okay, so if I had $1,000 and I needed $1,000, then I knew it was going to be $1,000 at the end. So that's my base value of something, and I'm going to get 6% interest on it for 5 periods. Then how can I compute that? It's $1,000, and I said 6% interest for 5 years. I would come down to the 5 periods right here for 6%, and my factor would be 0.747. Once I have my 0.747, I multiply that. And my present value would be $747. What that means is if I would deposit $747 in the bank at 6% interest for 5 years, I one time put $747, then it would be worth $1,000 at the end of that 5 years. That's how that works. That's compound interest compounded annually. Now, if I was going to compound that interest semi-annually, and just because of the way this table works, well, semi-annual won't work there because we don't have a 2%. So let's say 8%. So same scenario, only I was going to earn 8% over 5 years annually. That would be, my factor would be 681. Which means if I could earn 8% interest, I could deposit $681 in the bank, and in 5 years it would be $1,000. Okay. Okay. Now, if I could get semi-annual interest, this would be annual interest. Okay. If I was getting semi-annual interest, I would need to divide my interest rate by 2. So 8% divided by 2 would be 4, and multiply my periods by 2. But 5 times 2 would be 10. So I would use the 4% column, but for 10 periods. So my factor would be 676. I would only need to put in $676 because it would be, my interest would be earning interest on that. So I could put in less money. This is semi-annual at 4%. Which is actually 8% annual interest. Whoops, playing with my keyboard here. Does that make sense? Makes sense to you, Rebecca? Okay. So that's a lump sum of an annual. That's when I'm using the present value table. What if I wanted to use present value function? Does anybody know how to use the present value function in Excel? That's right, Blue. The bank would tell you, or whatever your investment is, would tell you that it would compound semi-annually. Most banks are compounding daily, on your checking accounts or on your savings account. So you would actually have to divide your annual percent by 365 days and multiply your period by 365 to get the actual interest. So if it's quarterly, I would divide my interest rate by 4 and multiply my periods by 4. Monthly, I would divide my interest rate by 12, multiply my periods by 12 to get this to come out. But yes, you would see what your investment was. The more often, when you're earning interest, the more often it compounds is a good thing. When you're paying interest, the least often it compounds is a good thing, if that makes sense. If you can buy something on simple interest or sign a note for simple interest so that your interest isn't earning interest, that's an advantage. Or you're not paying interest on the interest that accrues, that's an advantage. Unfortunately, those are few and far between these days. You used to be able to borrow a note simple interest. It's harder now to do that. So if I want to use present value in Excel and as a function, then I usually just put in the formula, and to do that, I've done it enough that I know that it's equal PV, and then I put my parenthesis, and it'll pop up, and it will tell me what's your rate, what's your number, periods, what's your payment, what's the face value, and what type is that. Well, when I first started using Excel and these functions, I didn't know what all of that even meant. So I used to do the function here. Then I will tell you, the person who teaches Excel the other day was in my office, and I was doing something, and he caught me doing that, and he says, "Why aren't you using the ribbon?" So if you've had an Excel class, then it's all about using the ribbon, and I just haven't ever really been much of a ribbon user, so I'm going to try to use the ribbon tonight. So I know that this is a financial function, so I can click on finance. If I didn't know, I would have to search for that, but I do know. So present value, I can come down and get present value. It will pop me up a little table here. Are you learning a lot about it, Rebecca? Rebecca's taking Excel this semester. Have you learned how to do present value? Yes. It's pretty fun, isn't it? I will tell you, I know how to use Excel, and I know how to use Excel pretty well, but I'm an old version. Yeah, lots of you are. So I've used it more. I always right-click and pull up the menu because that's how I learned to use Excel. And students in the classroom teach me a lot about the newer version. So anytime somebody shows me something new, I try to use it. So anyway, that's where we're at now. If I was going to use this Excel to do these very examples I just did here, my first example, my rate was 8%, and I would put that in as 0.08. My number of periods I was doing was 5, I believe, right? I do not have a payment because this isn't a payment. It's one amount, a lump sum, or of 1,000. I need to put that in as a negative. It tells me to maybe it doesn't tell me to put it in. It doesn't tell me here to put it in as a negative. In your book it does. Something I just know to do again. And my type, I can put my type in, or I don't have to, but the type is for annuities, and it would be, if it is an ordinary annuity, you use 0, and our annuities would be ordinary because the payment would be made at the end of the period, or if it's an annuity due, which means you'd make the payment at the beginning, you would have to put the 1 in. So the only time this would matter is if you actually had an annuity due and you needed to fill that in with a 1. Okay, so this actually will let us see right here that our present value is 680.583 something something. This is going to be a little more accurate than what we compute over here because we plugged in 3 decimal places here, and Excel is going to take it as far out as it is. If it's a repeating decimal, it's going to carry it all the way out, so it will be a little more accurate. Once I get that information plugged in, I can say OK, and it gives me my answer right here. So again, I can see my formula here, and I could have just typed that in. If I need to change that, or I want to change that then for the semi-annual interest, I actually can, again, I'll go back through the ribbon again, trying to be nice. I can actually let Excel do my math for me. And I can say this was my 0.08 divided by 2 because I was doing it semi-annually. I had 5 periods times 2 because I'm doing it semi-annually, so it'll be 10 payments. I'll get interest 10 times. My value again was my minus 1,000. And that gives me the 675.56. Does that look simple enough? Okay. If it's an annuity, then let me escape out of this. If it's an annuity, my table, you will notice that most of the tables are 1 point something or more. If it's just in the first period, it's not, but then they're bigger numbers if I'm doing an annuity. So if I was looking at an annuity and I was going to put $1,000 in at the end of every period for 5 years at 8% interest, these formulas would change because I now have a payment of 1,000. So my middle amount here would be my minus 1,000, and I don't have a future value in there any longer. And I have one too many zeros because my logic tells me that was too big a number. Okay. So if I put in $3,992.71 earning 8% interest, or if I wanted to be able to get back 5 payments of 1,000 at some period in time, I would need to put in this $3,992 because I'm putting in $1,000 at the end of every year. And that would be my present value of that type of investment. And I could do the same thing here. I want to, it's just use, well, that's using the present value. If I was using the table, then I would need to go 8% times 5 for my 3.993. And that gave me 3993 as opposed to the 3992.71 using the function. So just as an example, you pick up the rate and the number of periods. If it's semi-annual, I divide the rate by 2 and multiply the periods by 2. If it would be quarterly, I divide the rate by 4 and multiply the periods by 4. It's just the way that it works in this function. So this goes through showing you how to do it in Excel too. And looking at that's basically it. I want to look at just a couple of things in Excel real quick, and then if there's any questions we can answer those and we should be good to go. Let's say we had the opportunity to invest in bonds, and we were going to invest in $10,000 worth of bonds let's say with a face value base interest of 4%, when the market rate is 8%. And I want to know, what is the present value of these bonds? What would you be willing to pay for these bonds if you were buying them for an investment? Would you be willing to pay $10,000 for that? Would you pay $10,000 for these bonds? The face interest rate is 4% and the market interest rate is 8%. What do you think? Would it be smart to pay $10,000 for them? We don't know. Okay. We're not sure, right? Okay, how do we figure when it matures? Hey, that's a really good question, Blue. How would you know when I didn't tell you how long it was until it matured, right? What if I say 5 years? I think Blue's onto something because she knew I needed to know how long. So we would need to do a couple of things here to compute what we would be willing to pay for this. First of all, we would need to know how much the interest payment is. I didn't say anything about this being semi-annual, so the assumption would be that it's annual. If it is annual and I have base interest of 4%, it is going to actually pay out. If you invested in this $10,000 worth of bonds, you would collect 10,000 times 0.04. You would collect $400 interest a year. Okay? Knowing that I would collect $4,000 or $400 a year in interest, that would be my payment. My face value of this bond is $10,000. Now that I know those two items, nope, it's really not worth, I had a question, so is the bond really worth $10,000 when it's bought initially? It's not in this case. The reason that it's not worth $10,000 in this case is because the face interest is 4%. The market rate is 8%. So if I had two choices to invest my money, one, I had $10,000 I was ready to invest in bonds, and I could invest in one bond that was paying 4%, or I could invest in another bond that was paying 8%. I'm going to invest in the one that's paying 8% every single time, as I would hope all of you are going to do that as well, because that's where you can maximize your earnings. But the problem is both of these companies went through the process to get these bond issues ready to go. They both spent all this money. They have it all out there. So the government has this means, or accounting has this means, which is government driven, to level the playing field. They want the company who set their bonds up to only pay 4% interest to still be able to sell those bonds and raise the money. Okay, so in order to do that, this process is in place to issue these bonds at a discount. That's how we determine. That's the use of determining the present value. So let's look at how that works out. In this case, we're looking at a higher market rate. So with doing that and doing the present value calculation, and I showed you the tables, but we're going to, again, this is just annual. So in order to compute the present value issue price of this, I would use the market rate to compute. So I'm going to say 0.08, and the number of periods was 5, and my payment amounts were 400. I mean, I'm going to put in minus 400, and my future value is 10,000 minus 10,000. And I can close that. So as an investor, I would be willing to pay $8,402.92 for this investment. Now, the difference between that $8,402 and the $10,000 is the discount on this bond. It becomes interest expense to the company that has issued this bond over time, and it becomes interest revenue to me who bought it as an investment as I amortize this over time. And again, we're not really doing any amortization in this chapter, but it is a process of where we use up that discount. We do it in the next chapter. But because of the interest rate, and that the interest is only going to pay me $400, I pay less. But when I get my investment back for this, I get $10,000 written back to me. So I get the less interest, but I paid less for it, and I get the full $10,000 back, like I paid for it. Like I paid $10,000 for it, because that's the face. Now, what would happen if I change my interest rates and I say it was it had a face value of 4% still, but the market rate was 2%. How does that affect this? In that case, it would sell at a premium, because I would pay more to buy something that was paying me more interest. So my interest payment would remain the same, because it's always my face interest. And I'm using my market rate again to figure my value. So in this case, I would be willing to pay $10,940.69 for the same bond, because it's going to be paying me 4% interest when everyone else for the market rate is 2%. The best I could do is 2%. So I'm still doubling my interest rate. That's just that's the way we compute this. In this case, I actually was figuring all in one formula. I was figuring my amount of interest and my amount of my whole amount together. I could calculate my lump sum and then calculate my interest and add them together. That's what I would have to do if I was using the tables. I'd have to calculate the lump sum on my base value and then my annuity payment amount on my interest. So that's really the trickiest part in the chapter probably,